Now, as Mark just reported, Facebook's purchase of WhatsApp has pushed technology deal-making to the highest level since the dot-com bubble burst at the start of the century. That $19 billion takeover is, in fact, the fourth biggest technology acquisition in history, and it means that $42.4 billion worth of mergers and acquisitions have been agreed upon in 2014 alone. That's a 14-year high, and we're not even at the end of the second month of the year. So are we in a tech or social media bubble? Joining me with his perspective is Denmark West, advisor at K1 Capital. Denmark, good to have you back again.
Thank you.
So Denmark, we have these girthful, extravagant evaluations. Is the sector overheating?
So I think that one of the things that's important to understand, at least when we talk about Facebook and WhatsApp, is that this is very similar in a lot of ways to what we talked about with Instagram. One, these are people that Mark Zuckerberg already knew.
Right.
Two,
friends. They discussed the deal over dinner, in fact.
They discussed it over dinner on Valentine's Day.
Very romantic.
Two, there were competing bidders. In last case, it was Twitter. This case, it was Google. And so anytime you have competitive bidding, you're going to be in a situation where the price goes up. And three, and probably most importantly, this covers a place where Mark Zuckerberg felt a little bit exposed. So with Instagram, it was around mobile and the exposure around photos. In this particular case, it was international growth.
But Denmark, let's look at the big picture here, other than this deal. Now we've got a $19 billion purchase, which has set a precedent. We had Twitter listing last November. Despite making some losses, the company's valued at about $30 billion. We've got King, the maker of Candy Crush Saga, one game, looking to list on the IPO, and we saw looking to have an IPO. We saw what happened with Zynga.
Yes.
Starting to feel a little circa .com 2000. And we have all these instant overnight millionaires and billionaires.
I don't know if that's a bad thing. You know, I think that the challenge that you've already expressed, which is important, is that there are some situations where the valuations have either been overheated or a little bit out of touch. If you think about the Zynga example, the big challenge that you have there is that you misjudged what type of business it was. People valued it like it was a software business, and it was really more like a movie business.
I want to draw your attention to the chart that we've got on the screen right now, and that's the NASDAQ 20-year chart. As you can see, we had that big run up to the 2000 dot-com burst. Then we had that big bubble breaking, and we're starting to see that pattern resemble. I mean, the NASDAQ has risen by a third in the past year. It's almost at its highest level since the dot-com crash. Is this a concern? Are we seeing a pattern forming here?
The chart that would be more interesting is the relative price to earnings valuations.
Okay.
And so if you think about where the valuations were back in 2000, you know, they were in the 40s in terms of PE. If you look at where they are now, especially around the large caps, where you're thinking about the Microsofts, the Oracles, the SAPs, they're in the teens. You know, Apple is trading in the teens. Microsoft's trading in the teens. Oracle's trading. So the issue isn't necessarily about where is the stock price. The issue is going to be about where is the stock value, and that's how you determine whether it's a bubble.
But can they monetize? We have, for example, the WhatsApp deal. Basically, WhatsApp has said they're not going to have any advertising.
That's right.
They've said that they're going to keep their subscription cover very low at about 99 cents, call it $1.
Yes.
They've got 400 million users now. They grow to 1 billion even. How are you making back $19 billion in revenue?
So that's actually a great question. I'd say that the first point, though, is if you're at 400 million users and you get to 1 billion, even if it's 99 cents a person, it's still $1 billion business. So
okay, but you paid $19 billion for it.
Fair enough, fair enough. But I'm just saying that now we're talking about what's the value against that revenue, right? And we've seen other companies that have been valued, let's just say, highly against revenue. That's the first point. But I agree with you, that's an excessive valuation. The second point is, independent of that transactional model, that subscription model, how do you actually get value out of it for Facebook? Now, the challenge is, the owner has said explicitly, we're going to be no ads and no spying. So the whole notion of the data capture being somewhat limited. I think that he's half right. I think that the no ads is probably going to be true, but I think that Facebook, and you've had this conversation before, Facebook is really around identity management and data behavior capture. And I think that once you actually have additional information, especially real-time conversation and context, against that 400+ million, it changes the quality of your targeting. It changes the.
So another avenue for personal information collection. Very quickly,
Yes.
Denmark. Is this a trend that we're going to be seeing consolidation of these big players, the Facebooks
Absolutely.
and the Googles buying the smaller apps?
So Google was already a bidder. So that already tells you that Google is thinking about it. Viber was most recently purchased for a little bit less than $1 billion. And the issue here is it's not about how easy it is to get into the market. It's how hard it is to get to significant scale. So once you actually see somebody break through at significant scale, where they're saying, I've got hundreds of millions of active users, well, then the big guys are going to take notice, and they're probably going to be willing to pay up.
And pay up they did. All right, thank you so much, Denmark West advisor at K1 Capital.